Welcome to this video series about measuring value creation in private equity, where we talk about the 5 different ways to measure the drivers of private equity returns. My name is Mike Reinhardt. I've worked in the industry for 15 years. I run a website called AUXILIA Mathematica, and I wrote a book titled Private Equity Value Creation Analysis. These videos cover findings from my work, website, and book, and they're designed for private equity practitioners who use data to raise capital or evaluate the returns of private equity deals, funds, GPs, and investment programs. If it's helpful to you, subscribe and check out the website where you can download the Excel files behind every episode. This is video number 6 in the value creation series. In the last 2 episodes, we described the derivative model, which measures value creation in dollars, and the logarithmic model, which measures value creation in equity return multipliers. In this video, we'll show you how to convert all the dollars into multipliers and the multipliers into dollars, so we can compare how the different models and methods stack up. The 5 return measurements that we'll discuss here are absolute value creation, measured in dollars, for which we use the capital V, times money, which is value creation as a fraction of invested capital, a capital TM, relative value creation, which is measured as a percentage of shareholder equity change, for which I used the lowercase upsilon, the equity return multipliers discussed in the last video, using a lowercase chi, and finally, value creation IRRs. Absolute value creation comes out of either the conventional model of value creation discussed in episode VC102 or the derivative model discussed in VC104. It gives us a familiar value bridge where invested capital and the value drivers add up to realized or unrealized value. We also see that EBITDA growth and multiple expansion add up to the unlevered return. The unlevered return and leverage effect add up to the isomeric return. And the isomeric return and fund ownership impact add up to what we call value creation, the gross return, or the GP's change in equity value. And you can express this as the sum of EBITDA growth, multiple expansion, leverage effect, and fund ownership impact. If you divide everything on this chart by invested capital, you'll get the times money value creation, which was discussed in episode VC103. In this model, invested capital is always 1.0x and everything else scales to it. Quite often, the bottom part of this chart is removed, so that in the times money domain, value creation is always equal to the gross multiple of invested capital minus 1. And the times money value drivers for EBITDA growth, multiple expansion, leverage effect, and fund ownership impact add up to this number. Now, that's not the only way to rescale the absolute value creation chart. We can also divide everything by equity value change, or the difference between invested and realized capital. In this domain, value creation is always 100%, and the value drivers always sum to this number. This is basically taking a pie chart view of value creation like we see here. However, value drivers are often negative, and I don't like to put negative numbers into a pie chart. 10% of a 360-degree circle should always have an angle of precisely 36 degrees, and that's not the case when you mix in negative numbers. So for relative value creation, I prefer a value bridge like we showed before, or a chart like this one. Here, total value creation is always 100%, and the chart makes it clear that EBITDA growth and multiple expansion add up to the unlevered return and the leverage effect add up to the isomeric return, and the isomeric return and fund ownership impact add up to the GP's gross return. Now, some of these charts can be a bit tricky to build, but if you go to the website on this episode's page, you can download an Excel file that has a template for each one. The next return measure is the equity return multiplier that we discussed in the last video. Unlike the last 3 measurements, the value drivers are not related by addition and subtraction, but by multiplication and division. The fundamental unit of value creation is the GP's gross multiple of invested capital, which is 2.0x here. Value drivers that are bigger than 1 work to drive the gross multiple higher, and value drivers that are less than 1 work to drive the gross multiple lower. For example, the fund ownership multiplier of 0.97x indicates dilution, and it explains why the GP's multiple slightly underperforms the entire shareholder group, who have a total equity return of 2.07x. The GP's return is the product of this 0.97 and 2.07, which gives us the gross multiple of invested capital of 2.0x. Likewise, the product of the unlevered return and the leverage effect gives us the isomeric return multiplier. The product of EBITDA growth and multiple expansion gives us the unlevered return multiplier. And if you take the product of the multipliers for EBITDA growth, multiple expansion, and leverage effect and fund ownership impact, you get the GP's gross multiple of 2.0x. The final return measurement is the value creation IRR. This tells us the IRR impact of things like EBITDA growth and multiple expansion, but note that we did not put them in the form of a value bridge, because value creation IRRs are not related to one another through addition and subtraction. Like the equity return multipliers, they're related by multiplication and division using this formula here. When you plug in the value creation IRRs, you get the GP's gross IRR of 18.9%. Okay, let's talk about how you convert these different measures back and forth so we can compare the accuracy or precision of the different models. For an example, we will use the EBITDA growth formula. The derivative model provides our starting point in the form of absolute value creation, and the logarithmic model provides our starting point as an equity return multiplier. We'll start with the derivative model. To get times money, you simply divide absolute value creation by invested capital or the fund equity value at time 1. This gives you the following formula. To get relative value creation, you divide absolute value creation by the change in equity value, or delta effect V, which provides the following. Now, to get the derivative model version of the equity return multiplier, you take the GP's gross multiple of invested capital and raise it to the power of relative value creation. The derivative model formula is as follows, and I think it's pretty amazing that this complicated expression gives you a number that is almost identical to E2 over E1 that we see over on the right-hand side. Now the value creation IRRs, these are calculated like a CAGR. You raise the multiplier to a power of 1 over the holding period, and then you subtract 1. If you did all this in one step, you'd get a formula that looks like this. Now over here in the logarithmic model, the technique for converting a multiplier to a value creation IRR is the same, but the formula is a lot cleaner because we start with a much simpler equity return multiplier. Now, some of you very clever math folks out there are probably thinking, hey, that's not really an IRR, and you're right. This gets really close to what an IRR should be for a deal that has only one inflow and one outflow. If you have follow-on investments and equity distributions and dividend recapitalizations and so forth, you can't use the holding period for delta T. You need something that I call the effective holding period. It's really easy to calculate for most deals, you just need 2 numbers for it, but we'll have to wait to discuss that in a later video. Okay, we're over here in the logarithmic model, where the value drivers are still related to one another through multiplication. To get back to where the value drivers are related by addition and subtraction, we need the natural logarithm. Relative value creation is the natural log of the equity return multiplier divided by the natural log of a deal's gross multiple of invested capital. The logarithmic model's version of the relative value creation formula looks like this. To get absolute value creation, we multiply relative value creation by the change in equity value, or delta effect V, as follows. And then to get times money value drivers, we divide absolute value creation by invested capital, or effect V1, and this is the formula. Okay, let's work these out using the same company that we discussed in the last 2 videos. Enterprise valuation grows from 100 to 180, net debt is paid down from 20 to 0, EBITDA grows from 20 to 30. The table provides all of the deltas and averages that we need for the derivative model, and all the equity return multipliers that we need for the logarithmic model. For EBITDA growth, we start with a derivative model absolute value creation number of 25.69 million and a logarithmic model equity return multiplier of 1.500x. Dividing the derivative model absolute value creation number by 44 million of invested capital gives us 0.584x of times money. And dividing the derivative model's absolute value creation number by 44 of total value creation gives us the 58.39% of relative value creation. Raising the deal's 2.00x gross multiple to the power of 58.39% gives us an EBITDA growth equity return multiplier of 1.499x. And as promised, this is really close to the logarithmic model number that you get when you simply divide exit EBITDA of 30 by entry EBITDA of 20. The deal has a holding period of 4 years, and because the equity return multipliers under both models are quite close, the value creation IRRs under both models are also quite close. They're within 0.2%. Logarithmic model relative value creation is log 1.5 divided by log 2, which gives us 58.50%. You can multiply it by 44 million of total value creation to get absolute EBITDA growth of 25.74. And then divide it by invested capital of 44 to get EBITDA growth times money of 0.585x. So this shows that even though the derivative and the logarithmic model equations look very different, and even though that they're derived under a different set of assumptions, the results are quite robust and comparable to one another, usually within a few tenths of a percent. On the website, you can find an Excel template that has all these calculations for the value drivers that we discussed, as well as examples of the charts that we showed earlier. So now we can convert every value driver from one measurement to another. We just need the derivative model and the logarithmic model starting points. This table provides those starting points for the value drivers discussed thus far, as well as for new ones. The revenue growth and EBITDA margin expansion terms combine to create the EBITDA growth, and the gross margin expansion and operating margin reduction terms combine to form EBITDA margin expansion. These latter two value drivers measure how COGS and SG&A changes influence the returns. So let's use this table to propose a few generalizations. The derivative model is more intuitive. It's easier to wrap your head around the equations where EBITDA growth is proportional to a change in EBITDA, revenue growth is proportional to a change in revenue. You need to think harder about the multipliers on the right, especially when the natural logarithms come into play. That said, the logarithmic model formulas are much easier to use. To calculate revenue growth, you only need two numbers, revenue at exit and entry. In the derivative model, you need 10 numbers, 2 for each delta or average. In addition to revenue, the formula includes EBITDA margin, valuation, equity ratio, and fund ownership percentages. But note that not every logarithmic model formula has the convenient form of exit value divided by entry value. That works for the first 9 because the components are all related by multiplication and division. The last two value drivers, for gross margin expansion and operating margin reduction, they're related to the parent EBITDA margin expansion by addition and subtraction. That's why their logarithmic model formulas break with the pattern. In the next video, we'll describe two new value drivers that also break the pattern because of a fundamental addition and subtraction relationship. The leverage effect is driven by changes in a company's equity ratio, but it can be broken into two fundamental causes. The first is simply cash flow generation, which is the paying down of debt or accumulation of cash on the company's balance sheet. And the second is gearing, which explains how debt can amplify equity gains and losses and how growth equity can dampen equity gains and losses. We'll show you how that works next time. Thanks for watching. If you're into this sort of thing, subscribe and check out the website AUXILIA Mathematica. Registration is free and allows you to download Microsoft Excel files with all the data and charts used in these and other videos. On the site, you'll also find other resources like articles, templates, and a private forum for Q&A. When you visit, check out the site's free online value creation calculators. These web pages allow you to select various analysis parameters, plug in your own capital structure, P&L, and market data, and then measure value creation with a click of a button. I don't think that these calculators will replace your Excel models, but they're really useful for both preliminary investigations and double-checking that your own spreadsheets are generating the right numbers. I should mention that if you're looking for a convenient reference and training tool with a form factor of a college text, make sure to check out my book, Private Equity Value Creation Analysis, on Amazon.com. And finally, if you'd like to get up to speed with models like this more quickly than the book or the website allow, get in touch. Over the last 15 years, I've helped dozens of GPs build models like this for various fundraising and investor relations projects. Thanks for watching, and see you next time.